Hey traders, Raghee here. Welcome to Charts and Coffee. Happy Friday, gang. We're dealing with some data here today. We do have the University of Michigan data coming out at 10 a.m. Eastern, so at the top of the hour. We also have some data that we're responding to right now. Well, not right this second, but earlier today, we had two pretty big data releases. Number one was core retail and retail sales. So they're really the same. They're really the same data dump. It's just that core retail excludes automobiles and retail includes them. So same thing, just a slight variance in the calculation of what they're finally giving us. Now, it's really interesting that these were relative misses. Core durable goods came out, but not as big an event as the core retail sales would be. And here's what's interesting. And I wasn't sure about how this would go forward, but it looks like this is going to be the way it goes. So this is something to keep in mind. And we now have a little bit of data to support this hypothesis. If you remember back 8 months ago, 6 months ago, it was very common for a miss in data. Let's say it was jobs or even GDP, but if the economic health of the company was weaker, jobs missed, etc., the equity markets went higher. Now, why was that? That was because it basically emphasized that the Federal Reserve has to act, right? Well, the Federal Reserve finally acted. All right, now the next thing is the health of the consumer. So if we're looking at core retail sales and we're going to apply that same thinking of a miss is actually bullish to equities. Why? Because it now then emphasizes continuation of the cuts. So first it was, we want to see the cuts happen. If jobs are a miss and inflation sort of flat, it's time for the Federal Reserve to do something. Well, now that they're doing something, the question is for how long will they do it? At what pace will they do it at? And so next thing would be looking at core retail and seeing, oh, that's a miss. And looking at that as a potential bullish catalyst. So keep that in mind with things like core retail sales. What is the consumer doing? Yes, are they employed is definitely a metric, but are they spending their money? Is this lower cost, sort of lower lending rate environment, lower borrowing cost environment, is that stimulating more spending? And that's really one very direct metric to look at it. And so I'm going to look at this miss as bullish, not because I'm saying that, but because let's go back to the charts, right? We have a hypothesis. We know that it's applied to other metrics in the past. And now take a look at what's going on with the S&P. By the way, Russell, Dow, S&P, and NASDAQ are all trading above the previous session close. And while we're stuck in a range, once again, we're stuck in another range. You can see that with the automatically drawn Darvis, the two yellow lines on this daily time frame on my chart. You'll see we're stuck in a range again. Not as narrow, though, as the range we were stuck in for about 3 weeks back in late September to early October. It's a little bit wider. The wider the chop, the more tradable it is because to traverse one end to the other, there's more movement. More movement means more potential follow through. But this is not as narrow, but it's still a chop that we're stuck within. All right, so then the next thing that I'm going to look at here is what's going on with bonds and gold. Now, bonds have been a tricky symbol to trade. And this is what I mean. And it always is this way. It's just a little bit more emphasized right now. Bonds are typically looking ahead 3 to 6 months. They like to play a game of chicken with the Federal Reserve, and they're usually thinking about what monetary policy and what interest rates might be, say, 3 to 6 months from now. And ultimately, what that's going to mean for what's happening in the ZB futures chart is that as this thing moves lower, rates are higher. Again, what the bond rates are, but they're also making this bond rate is really a multi-fact. This is a very complicated instrument. It's not only not measuring the now, it's measuring 3 to 6 months from now, so 1 to 2 quarters from now. It's measuring recessionary type expectations. It's measuring what the Federal Reserve might do come January or March of next year. So it's an interesting chart. I don't trade bonds that much because it is a complex instrument. I don't think it's straightforward, and it's going to react to things that may not seem that they have a lot of proximity to what we're reacting to now, but rather the implications 3 to 6 months from now. That said, they're in a downtrend, right? So take all that stuff out and say, okay, Rog, at the end of the day, what would you have to do with bonds? I would short a rip, right? But I don't like having to play higher yields on bonds while the Federal Reserve is cutting rates. It's just, I don't know, it just messes with my mind. So what I want to do then is focus on gold, which has a far, for me, cleaner uptrend. I like being long in a symbol that is benefiting from the narrowing of real yields or real interest rates. It makes sense not only from a technical standpoint, but from a macroeconomic standpoint to this trader. So what I want to do is focus on the long gold trade, but I would be bearish bonds. They're up a little bit. So if you look at the intraday look, bonds are up a little bit, and that just means just a small bit of lower yield reflected in that short-term 5-minute time frame as opposed to the daily time frame. That's been in a downtrend since the 15th of the month, and red candles pretty much dominating since, well, all of October. And that's where we sit right now. All right, so then the next thing is looking at the the NASDAQ. The NASDAQ's been an interesting index because two of the stronger sectors this month have been XLK and SMH. We continue to be long PYPL as well as I actually closed out my NVIDIA trade yesterday, not because I don't love it to the upside, but because I'm just running out of time. They expired today. So we bought, days ago, sometime back, what was it, on the 15th? We bought NVIDIA calls, 130 NVIDIA calls for October 25. So I've just got to get out of those. If for no other reason than I'm just out of time, I would look to consider being long NVIDIA going forward. The other thing that, and I'll just, again, talk my book here. In fact, let me just open that up. I do have a lot of, probably a little too much, right? I'll definitely admit to that. Maybe a little too much right now waiting in gold. So these are the symbols we have open right now. We closed out our aggressive entries on gold. So we have multiple places we might scale in. So what we do in the trader alert recap is very simple. The sector secrets mastery, every entry, every exit, every day. So this is what we've got. Still long PayPal, still long GLD from the moderate trigger, which did not get stopped out yesterday, and Zion. The gold aggro wasn't bad. We got in at 320, got out at 402, and I had to close it at break even, both the November 1, 251 calls and the November 15, 251 calls. And then we just got into GDX. So I look at what's happening tech-wise, and I probably need to start focusing a little bit more exposure on tech. I mean, we just had a very nice multi-target run on NVIDIA. I'd want to put Taiwan Semi on that list as well. So there's a lot more that I do want to look for entries on, and I'm probably a little light on tech. I'm definitely wanting to get into some financials too. So that's when I look at what I've got right now and what I'd like to have. I'd like to be in a little bit more some of the relative outperformers on the tech side of things, and definitely I'd like to find myself in a few more opportunities to take advantage of pullback buys in financials. All right. Okay. So next up is looking at what we've got going on in financials. Rog, what do you want in financials? It's actually easier to talk about what I don't want in financials. I won't say I don't want Citi. It's just not near the top of the list. But I'll likely pass on Visa and Berkshire. And I'm going to share with y'all something that we have a saying. So most of you know the Trish Boss, if you're in the sector secrets mastery. And we have a couple Trish Boss rules running right now. So if you're looking at some guidelines to help you out, one thing that's been working pretty darn well is having a much smaller window for entry on my day trades. I forgot I still had my little samurai pony in there. I should look at the camera a little bit more often. Hair and makeup is not my bag. But anyway, if we're taking a look at day trading, what's worked pretty darn well as a filter, right? Remember, filters remove things. What's worked really well as a filter is looking at, rather than say the first hour or even the first 2 hours of price action, looking at the first 30 to 35 minutes. And if nothing's happening, letting it go, because things have not been really organized from a day trading perspective. And the later surges we sometimes see in the broader averages have been benefiting the swing trades that we have on. So rather than really forcing a particular time frame or style to produce results, which right now they're just not producing, we're really kind of not going all in, but we're shifting more of our attention to the symbols, to the time frames that are giving us follow through. And that's been the swings. The second half of the month has been really good for swings. I mean, take a look. This is the second half of the month. Things like XLB, Cisco, gold, SPY, gold again. Gosh, I've been in gold a lot this month, interestingly enough. All right. So that's really definitely been something that we want to think about. Are we spending too much time on a particular symbol? Right? I'm going to ask myself that on gold. Am I spending too much time on a particular type of strategy, meaning day trading? Asked and answered, right? I want to be focusing on less time, looking for the very best, earliest setups, and then moving on rather than trying to force it to do something. And then focusing on where the follow through has been, finding strong sectors and finding strong stocks within them and taking advantage of that movement. So those are things like TSM, some of the outperforming semiconductor stocks and SMH. Oh my gosh, TSM and SMH. And if I take a look at financials, again, it's hard to find something we don't like. So that we definitely want to keep our eye on financial, which wonderfully have the earnings in the rearview mirror. Let's talk about earnings for a moment, because I know there's a couple symbols, maybe a few symbols on people's minds. I know it's on mine. What is going on with Newmont Mining? You think they're going out of business with the way this is selling off? Here's what I know. I don't know where this thing is ultimately going to find a floor. The way that I tried to take advantage of this pullback, but dilute the uncertainty, was I bought GDX, where Newmont Mining is the number one weighted stock. Understand your sectors. It's going to help with your watch list building. The other symbol I know a lot of folks have questions on is IBM. I'm interested in IBM. IBM was one of our biggest trades in September. It was either a 3 or 4x trade. Gorgeous overall uptrend. I'm going to keep an eye on IBM to see if we can get perhaps an inside candle today, leading to possibly a Friday or Monday entry long in IBM. So I want long calls here. I don't hate my money. I'm not looking to short this thing or get long puts. The last one a lot of folks asked me about was Tesla, right? It went straight up. Great. Good for it. Here's the thing, gang. It's not the candle. It's not this particular candle that's of interest to me. It's look upstream. What happened before this candle? And in fact, in both these situations, these are very counterintuitive moves. An overall uptrend like IBM gapped down massively. An overall strong stock like NEM gapped down massively. So is earnings just a counterintuitive play? No, it's not that easy. Here's a bearish, slightly neutral bearish chop, and Tesla gapped up. The fact of the matter is it's a coin toss, right? Flip a coin, take a guess. It doesn't necessarily mean that this is something that I'm going to trade in terms of that very binary look at does earnings beat or miss. I'm not a fan of that. I don't in any way consider that trading at all. However, the side of earnings that I don't play, which does make sense, is a side of earnings that capitalizes on the increase in the implied volatility and the vol crush. If you're looking to take advantage of vol crush, if you're looking to take advantage of traders who are willing to basically overpay into earnings, and then realize that after the event, the implied volatility comes down, the premium comes down, and you've sold options, that makes sense. I'm not a big fan of option selling. You might ask, well, why, Rog? Because you need a margin account to do it. And a lot of times traders forget that there's always a cost. There's no free lunch. We have a margin account that's below $25,000. You've got basically 3 trades every 5 business days. So either that's great because it's going to have you become a much more discerning trader, 3 trades, that's all you get, and then you got to wait for the reset. Or you say to yourself, do I really need to write premium? Would I rather be able to have the freedom to take the trades that I see as I see them, knowing that oftentimes there's going to be more than 3 every 5 days? I'd rather be that trader. So what I recommend most traders do is consider a cash account, long calls, long puts. And you might say, wow, that's pretty simplistic. I agree. The notion that as a trader is trading longer and becomes more advanced, that now they have to do these fancy multi-leg strategies, I've actually found you're going to get to a point where when you first start trading, you know very little, and then you know a lot, and then you want to know some more, and then you spend the rest of your trading career doing less. It's almost like this sort of expansion of all the things trading to finally realizing less is more. And you whittle away at your indicators, you whittle away at strategies, you whittle away at all those different opportunities, and you realize I need to be more like a filter, like a sieve, and I just need to take things out till I'm left with the very best of the things that A, I understand, and A, that are in my wiring. And part of my wiring is I like being a directional trader. I really like trading trends. Now, that you might say, Rog, I like them too. How do you know if you like trends? Did you grow your account in 2020? Anyone here not grow an account in 2020? If you grew an account in 2020, you like trends. It's one of the strongest trending years we had, other than maybe 2019 Q1. So if you find yourself growing, let's say the first 3 months of this year, did you grow your account? Did you have pretty good trades the first 3 months of this year? Presuming you weren't trying to pick a top. You might say, yeah, Rob, the first 3 months, now that you say something, we're pretty darn good, right? We're pretty darn good. That was a trend. The first 3 months of this year were probably the most reminiscent of 2020 that we've seen in a couple of years. So if you say, yeah, Rog, I'm noticing that sometimes my account's growing a lot better and other times I'm struggling. It's not the difference in the strategy. Usually it's a difference in the market behavior that you're applying the strategy to. So think about that. Look back on the last year or maybe the last few. Say, hey, when were my best months, my best quarters, my best years? And look at the nature of that symbol or of that environment. Say, oh, okay. Some of you might say, Rog, I do better in chop. Hey, it happens. It could be. I would say it's probably less likely, but hey, Rog, I do better in chop. Rog, I do better in a downtrend. Find the environment that you're good at, or as we like to say, know your pitch. We're not all going to have the same batting average on the same pitches. Know your pitch while you're standing there at the plate, and trading becomes a whole lot easier. I'm a buy the dip, uptrend kind of trader. And you'll notice that's been working pretty darn good. So think about that over the weekend, maybe some food for thought, a little bit of homework. And I will, and Smoke Divine says, I've been doing long calls and long puts with a cash account. It is amazing. Simple, honestly, don't need to trade any other way. I agree with you. That's what I've been teaching for years. Glad it's working out. And we don't have to overcomplicate things. In fact, you're going to find most of your career is going to be uncomplicating things. All right, gang, be good to each other. I'll see you on Sunday for Top Tier Outlook live at 6 p.m. Eastern. Okay, gang, be good to each other.